Our next session asks when and how wealth managers dive into private markets. It's my great pleasure to introduce as your moderator, Christophe Bavière, member of the Eurazeo Executive Board, Senior Managing Partner and Head of Investment Partners.
Thank you. Thank you very much. Hello, everybody. So please have a seat. I'm happy to introduce our panel. And so we are lucky enough to have a very senior panel and very experienced people on the retailization of private equity, which is a major topic probably this year in this conference. So I'm happy to introduce Nicolas Chaput from ODDO BHF, Marco Bizzozero from iCapital, and also Theo Delia-Russell from Mediobanca. And myself, as it has been said, I'm a member of the board of Eurazeo. And maybe it's worth for the four of us to introduce ourselves a little bit and to justify what is our experience on wealth management. Eurazeo in total is managing 33 billion euros, out of which a little bit north of 10% is coming from wealth management. Each one of our institutional expertise is now also offered through a product offering in wealth management. So this is for us. Nicolas, maybe I'll let you give you the floor.
So Nicolas Chaput, I'm heading asset management and private assets for ODDO BHF. ODDO BHF is a Germano-French financial institutions carrying and providing solutions for high net worth individuals and institutional clients in Europe. And we have roughly 140 billion euros of client assets in Europe. And we are now quite active into the retailization or democratization of private assets.
Marco?
So Marco Bizzozero. I'm responsible for the international business of iCapital. The mission of iCapital is very simple: to facilitate access to private markets for individual investors. So we do this with our technology solution, which are creating a bridge, a connection between, say, the asset manager and the wealth manager in a highly technology-enabled environment, which allow better access to this asset class. We are a B2B business, which means that our clients are, on one side, the banks, the wealth managers, and we help them getting better access to private market with our technology and solution. And on the other side, our clients are the asset manager, which we allow them, we facilitate them diversifying their fundraising beyond institutional investors and tapping into the growing wealth pool. We are a US headquarter firm. We rapidly expanded globally. Today, we're a truly global company. We're 1,000 people, of which 200 people are already in 7 international locations. On our platform, we have 136 billion, of which 25% are already from non-US investors.
Okay, my name is Theo Russell. I work for Mediobanca. Mediobanca, I don't know how many of you know it. It's the major Italian investment banking listed on the Italian markets. We are an investment bank with a private banking division. I am the co-head of the private banking division, and in specific, I am leading this transition of assets of our clients, which are mainly ultra-net clients, to private markets. So I think we pioneered in some stage this transition with some experience, and we are now moving to a more industrialized approach with iCapital. So maybe we will talk about in next steps. Okay.
Thank you. So it has been spectacular to see and when I see all of you in this room, it's spectacular to see the interest from wealth management and from private individuals to invest more in private assets. But maybe we can start with you, Marco, as your firm started in the US and as this trend started in the US. What have been the barrier to entry for private individuals in this asset class? And maybe what are the lessons learned from the US market?
So basically, the starting point is this very low allocation that private clients, high net worth individuals still have in private markets compared to the allocation that institutional investors have built over the past 20 years. So we speak about in private market, on average, probably 2-3% allocation to this asset class, and institutional investors are now 20-30%. What are the reasons? The reason are those historical barriers which were there, which make it very difficult for individual investors to invest in this asset class. And what were these historical barriers, or what still are the historical barriers? One is access. Access in terms of high minimum. Obviously, we all know, this asset class has very high minimum hurdles to invest, and which doesn't really allow high net worth individuals to build a diversified portfolio. So that's number one. Number two is, again, access. Access in terms of selection, in terms of identifying the right manager, and then really getting access. We all know that the top-tier managers, they're kind of oversubscribed, reserved allocation. So it's difficult for private clients to really figure out where to invest and then manage to get into it. Number three, it's if you manage to have access and if you have the money to invest, it's still a very cumbersome paper-based investment process for the clients and especially for the advisors who is working at a well-managed organization. So these create a huge barriers to entry. We all know what it means, filling up a subscription document, for example. But number four, even if you have managed then to do that sub-docs and invest, think about what happened during the life of the product. How complicated it is for client, advisors, and organizations to manage those products, which are so different than product on the liquid side. So the intransparency, which is also related to the reporting. And then the barriers, last but not least, it's all the topic about research, insight, education. Really have a transparent environment so that private clients can really look at it and choose what best fits them. And all those barriers are now taken out by technology. And what we are learning from the US, the company was founded 10 years ago in the US. What we are learning is something very simple on both sides, asset management and wealth management side, is the power of technology. The power of technology, how it makes it easier for wealth manager, their advisor, to deal with this asset class. And one thing that we are seeing as kind of one first result is what I call it the adoption of the advisors. How many advisors in the well-managed organization are now promoting actively private market in a diversified portfolio? Everybody sold about the need to have private market in a diversified asset allocation. All wealth managers are saying you need to have 10%, 15%. People have different views. But the reality is still very different. And the first order is the banker, is the relationship manager, which is very difficult for him to approach this asset class because it's very complicated. So we see with technology, the adoption rate of relationship manager is increasing significantly, which then allow portfolios to then include this asset class.
And maybe, Nicolas, you can tell us about how you see these trends now developing in Europe and in your organization.
No, absolutely. I think that there is a huge demand actually from wealth managers, specifically when I look at the markets that we target in France, in Germany, in Switzerland. Historically, we've seen high net worth individuals rather investing first into real estate. Now they turn to private equity or private debt as a complement to building their portfolio. I think that we are being helped in this regard also by the high volatility of the public markets that we've seen for years now, and all the different crises that are occurring, and the long-term perspective of the asset class. Now, to be successful in this respect, you need also to overcome a number of hurdles, which are also linked, in fact, to the fact that you're speaking to individuals in different countries that have different regulations, that have different tax, and you need also to be able to speak the language and have subscription forms that are not always in only one language, which is English, across, in fact, the different countries. So my belief is that, yes, there is a big demand, but to be successful today, you need to be flexible in terms of engineering, structuring, and flexibility is probably where I would say the historical players in private equity were not the best because they were institutional based with a number of clients with whom they worked directly. But working with high net worth distribution partners, it means having a different logistic. It means also being able to train the RMs on site, train the people in the different countries in their languages so that they can relay the information transparently, in fact, to their clients. So I would say that, one, we see a big trend now and a big demand in the large economies like France, Germany, Switzerland. You need to be flexible in terms of structuring the legal shell also that you're using, because you need to be adapting to local markets, to some local tax issues. France is a haven for that. And you need also then to adapt, in fact, to the language in order to convey the message. Not to forget technology, which is now, to me, key, because that is not the same to raise money and have 10, 20, 50 subscription forms and have 1,000, 2,000, 3,000, in fact, to deal with and to monitor. So that's where we are all now concentrating, racing to be ready in a way to offer this flexibility, this local approach to a global need, and the tailor-made solution.
Theo, Nicolas mentioned the issue of volatility, and I think we all have perceived this difference when we interact with clients where initially, the volatility of listed market was perceived as a benchmark, and to a certain extent today, this is perceived as a lot of noise, and the lower volatility that the private asset class are offering is perceived something more real than the incredible noise coming from the volatility of listed assets. Volatility is key, you mentioned it, Nicolas, but what's your experience? What does it take to be successful to attract private money?
Okay, well, I think that taking a step back, it's a completely new world, even from a philosophical point of view. The role of the players, it's completely different. We have to find a role for the distributor. So what do? We put some new things in the shop and we sell it, or we have to co-design, be responsible for what we sell, and have an active role in doing it. So I think in our experience that we have an active role. So we always want to co-design the product with the GP we are selling. That's the first point. The second point is we have to explain it. So it's mandatory for us that the GP has a structured sales team which is on the field with us to explain the product. So education is even for the clients. So we have a lot of tools now. It's much, much easier. So everybody has to have a role. And I think we don't have to be only a distributor. That's my view. especially because when volatility picks up, then clients want to know exactly what they bought and what there is inside in the product. And now is very, very easy because we have a lot of volatility in the markets, and it seems that the value of the private equity we sold is still stable, and in many cases is being helped by dollars if you are European. So everybody is happy, and I agree. I see an immense demand shifting from traditional mutual funds to private equity funds, especially semi-liquid in the future, which could go up to 30% of the assets. So imagine the amount of money will fly to private markets. It's huge. But we have to explain and to characterize everything for each distributor. Then there are some constraints. Of course, we need platforms. And as we were mentioning, if we do project by project, the effort is immense, and the concentration of the amount of money for each project is too big. So by having a platform like iCapital in the future, we will go back like having all funds for mutual funds. So we can be more accurate in designing the asset allocation by distributing vintages, distributing asset classes, and co-design. I mention again, co-design the solution with our partner.
And we all know our asset class, private assets, are so far a relatively limited asset allocation in institutional and in private individuals' money in Europe. But it covers, in reality, an incredibly diversified asset class. It covers private equity, private debt, it covers also infrastructure, and it covers also some strategies related to real assets. And even in private equity, the difference between venture and large buyout is incredible. So where do you see the appetite coming from private individuals? Where is it focused?
Well, our experience being an investment bank comes from club deals. That's the most excitement into the investment. Then, of course, I think that the Ferrari of of private market are the co-investments. It gets a lot of expansion with clients. But then again, I think that we will go for a more diversified and more blended solution, just to be sure that in the future we will have less bumpy flights. Because now it's easy to sell, everybody gets excited, a lot of money moves from mutual fund, as I mentioned before, to ETF or private markets. But then I'm sure that some tough time will come. So diversification will allow us to be more safe in the future.
Would you like to react, Marco?
Yeah, I can add a few things, and probably stepping back a little bit more, since Theo, with his organization, is already very much advanced, in in private market for the clients of Mediobanca. But we are actually, in general, starting from the very beginning. And the major driver for wealth management organization now in making private market, I'll call it a strategic priority, and it's actually more than a business opportunity. They see that as a responsibility. Because of the following reason, is basically the increasing importance of private markets across all the different strategies versus public market. That's where it starts, is comparing private markets with public markets. And over the past 20 years, private markets obviously increase in importance significantly. And if a wealth manager organization doesn't figure out a way to enable access to it, what happens? It happens that basically without private markets, you don't participate in the largest part of the equity allocation. Number of listed companies are continuing going down, not going up. Number of private equity-backed company, they significantly increase. So if you don't figure out a way to access that, then what happens? You don't participate in the value creation, which currently take place mostly when companies are private. companies are going public much later in their life cycle, which means that the value creation happens when companies are private, which means that that value creation goes to institutional investors and not to private clients. And that's what I talk about the responsibility from a wealth management organization to figure out a way to participate in that part of the value creation of a company, which, whether we like it or not, it's happening now in private market. And that's what's the major driver here. You know, if you look also at the public markets, I mean, now all the different indexes, if you take technology and if you take the top 5 companies, that very often it makes up 30-40% of an index. And many sectors, you know, many companies are really kind of excluded. So long story short, you know, public market is not anymore a truly representation of the real economy. And as a well-managed organization, there is that responsibility to figure out a way to get access to this.
And maybe a word on regulation and transparency. We all know that to deal with private individuals' money obviously refers to a much stronger regulation than institutional money. It's also maybe declined differently in some local European markets. And we all also perceive a need for transparency that is increasing and that maybe needs to be adapted when you talk to private individuals, that when you talk to very experienced institutional investors. How do you see these trends? And do you think the industry, the private equity and the private debt industry are able to adapt to this requirement?
You're asking me? Yeah.
Maybe, Nicola, you want to start?
Yeah. Yep, sure. And I think that's one of the key issues that we are facing now is basically as there is a growing demand for the asset class for affluent and high net worth individuals, there is also more and more interest from regulators to make sure that this is done in a way that is adequate in terms of transparency. And therefore, we are faced with a number of regulations today, which normally in Europe would be unified. If you speak about MiFID, MiFID II, and SFDR, sometimes you're being faced with the fact that some local regulators are still giving some different interpretations of these rules, so you need to go around that. But I would say that this is forcing asset managers and private asset managers to build also an engine for reporting. Because today, if you look at what will be the requirement of SFDR coming the 1st January of next year, this will be also a very important reporting aspect, both on the institutional but on the individual side. And if you look at MiFID, you know that we will all need to be asking our clients whether they want to be investing into something which is sustainable or not sustainable. And if they say they want to be investing into something which is sustainable, as an example, SFDR 8 or 9, you will need to be able to provide them a solution for that. So one of the big trends that I'm also seeing at the moment is, in a way, the thematic, is that the way we're doing it on the global ecological transition, we are seeing now managers looking at offering products to retail, to high net worth individuals, targeting, in fact, SFDR 8 or 9 regulations so that asset managers, wealth managers, are able to comply with the regulation and offering something that is demanded and more demanded by clients. If I'm giving you the experience we have with the German market on the high net worth and ultra high net worth is really geared towards sustainability. And therefore, if you do not have an offer which matches in a way or the other in a very transparent way and in a very non-greenwashing way, investment for, as an example, the global ecological transition, then it's difficult to break into these markets.
Theo, maybe you would like to react with the specificities of what you see in Italy?
Yes, what we are working for at this stage is to modify the traditional approach to the risk profile of the clients. So what normally MiFID does is that ask you to define which client has a conservative, a medium, or an aggressive profile. And this is a problem in terms of allocating private markets, honestly, because typically a conservative asset allocation does not include private markets, which is not the case in US, for example. So we are trying to redesign the MiFID profile by passing through some multi-generational type of risk profile where you have the space to introduce a little bit of private markets, even in conservative profile, like it happens in US, and this will change the world. So if we can use private markets even for the majority of conservative profile for the multi-generational approach, private markets will go to everybody in the future, and that's what we are aiming for. Of course, there is a lot of work in terms of risk testing to justify that you can use a product with high risk into a conservative portfolio, which is already happening in the US. I mean, we just watch at some investment bank in the US, and they do like this. So it's just a matter of trying and go for it. Maybe talking with regulators is exactly what we are doing in Italy.
And do you need some specific adaptation to the Italian market, or would you say that at the end of the day, the behavior is quite similar?
We do need, because unfortunately, the European regulation then has to be applied in each country. So for an example, in the insurance wrappers, where I see an immense space for private markets, the Italian regulators will be very reluctant to adopt it. Instead, in France, they're already using it. So it's a nonsense. So it's just a matter of time. So we will see a lot of space in insurance as well, in my view.
Yeah, no, absolutely. I mean, the French market is, as we know, very much geared towards, in fact, life insurance. That's for tax reason mainly, but it's also because it's been very innovative, as it can include private assets, which is great for clients, and that gives and has given a fantastic boost of that market for retail and affluent. One aspect that I want to mention also on regulation, and something that we still do not have the same rules applying in many countries of Europe, is what being considered a non-professional client. So what is a professional client, a semi-professional client, a non-professional client, and these hurdles are not harmonized across Europe. So we need also that, so that we can probably structure solutions and sell them to a number of different countries under the same regulations, which is still an issue.
Nicolas, you described the fact that for example, to serve the French market, there is a specific weight of life insurance in the French market, and so you need to be able to address the market, at least for the French market, both through direct subscription and through unit-linked subscription. Marco, would you see all over Europe, for some countries, the same level of need to adapt to local habits or to local structure of the savings?
Let me say the following. Obviously, this shows the past 5 minutes how complex is the landscape and how complex is accessing this private market with in different countries, and the solution differs. So it is complex. As a fintech platform, we are not going to be able to change that. But what we are able to do, we embrace this complexity, and we help with our technology to deal with all these different jurisdictions. Europe is complex, the world is complex. If you want to do something in Canada, you need something specific for Canada. If you want to go to Japan, it's different. If you want to go to Australia, it's different. If you want to go to Korea, it's different. So it's not just Europe, it's the world is complex. Hopefully, there is going to be an alignment. In the meantime, I think our task is helping, wealth manager and asset manager dealing with this complexity, and notwithstanding this complexity, having a solution to provide individual investor access to this. We're kind of agnostic to the way.
Marco, you mentioned the importance of technology, and I think we all have in mind the fact that the cost to entry into this asset class has been in the past quite expensive. And definitely technology, definitely digitalization offers a way to reduce the cost of access. How would you describe in your organization this importance of technological innovation and digitalization of the product offering?
It's basically making everything that was before manual, automating everything that was manual. Think about, and we want wealth managers to focus on what they want to focus. So they want to focus on selecting the right manager, building a curated menu of private market offering for each client, and then focusing on, on advice, on building the portfolio. And you want probably focus on generating the performance that he needs. And we kind of take over this kind of value chain in between, in aggregating and disaggregating all this huge amount of numbers of individual investors who want to invest at lower minimum, and then want to face Nicola with as one investors, and then he's going to send me one capital call. And with our technology, we're going to disaggregate it in hundreds of thousands of capital codes across different distributions, which can go automatically to the clients of Theo. And then the other way around. Yeah, so that's the vision.
Yes, I mean, talking about complexity, what I suggest is that in some cases, maybe you could have the temptation to modify the DNA of the product by shifting to a sort of usage type of private equity, by diluting the original and coherent approach of the private equity itself. So in my view, complexity has to be managed by maintaining the original approach of the private equity. Having said that, of course, we see an immense space for semi-liquid, but semi-liquid still keeps the private equity inside without modifying it. So I see that in some cases in the market, they tend to say it's going to be a sort of listed GP private equity type of funds, or some product that are not coherent with the approach that we need. I think that instead we have to keep original, invest in private equity, and manage complexity with technology.
And maybe something that we need to address today is the fact that obviously we are currently facing a very specific economic environment. First, there is war in Europe, and it may last for quite a while. And also, we are facing a quite unique economic environment where the return inflation is here, and where we see tightening monetary policies, maybe a little bit faster than some of us expected initially. Would you describe that this very specific economic environment facilitates or is an obstacle to the introduction of private asset classes in your client's portfolio? And how do you adapt maybe the strategies to better fit the current situation?
As I mentioned before, it's a tough time. I wouldn't say that it's not. It has been a tough time. We have a lot of volatility. Things are changing. People are moving to debt, to credit. So I think that we will have a lot of demand for private credit in the near future, because it's much easier to understand now that rates move up. The demand will grow because, as I mentioned before, we haven't had any volatility on private equity NAV until now. So people think that it's the Goldilocks. So they are moving to that. We will have some volatility, especially in secondaries, in a few months, I see. But still, the trend is there. So as I mentioned before, this is fantastic asset class to reduce the whole volatility of the portfolio. So I'm sure that we will move to 20 to 25% of the asset allocation of clients, starting from a 6 to 10% in conservative, from a 35 of the most aggressive one for ultra high net.
Nicolas, do you answer?
We are being asked a lot of questions at the moment by relationship managers, by clients to understand whether it's the right time to get into private assets or private equity. The questions are also, we're seeing the valuation of our public investments, being hammered down 20, 25, 30%, and nothing is happening in private equity. So we need to be very transparent about what is happening. We need to make sure that people understand the dynamic of the asset class, to show them that over time, over some periods already in 2007 and other periods, there was, in fact, a number of historic that we can show where there will be probably NAV changes, but they're usually not as massive as in public markets. And second, it's long-term. People need to understand the long-term value of private assets and the diversification benefit of private assets. So portfolios that are largely diversified, secondaries is a way to get a very huge diversification globally, worldwide. But also private debt is becoming something a bit more popular in a way that a lot of the private debt structures are floating rate rather than fixed rate, meaning then that you are not exposed to interest rate rise nor inflation risk. And this is attracting a lot of interest. So there are a number of things that are happening that are still very compelling, in fact, for the private markets, but you need to be transparent, you need to be educating, you need to be telling people what's happening, how it's been reacting over cycles so that they feel comfortable to allocate some money.
What is clear maybe also from what has been discussed today is that private individuals are not one market. First, there are some geographical differences, we covered it, and there are also some differences because probably the first movers in this market have been the family offices. For some of them, they have behaviors that are similar to the institutional money. And we see that some of the wealthy people, they are able to have a very selective approach to private equity. They are able to differentiate between growth equity, direct investment, and buyout. And probably there is a need to attract more mass market money, to go a little bit deeper with strategies, including, for example, private debt. How do you adapt in your organization this need to address private individuals' needs differently in each level of your market?
Well, I think that private markets has a fantastic field to be a first mover advantage. So moving first means creating performance and reputation, which is not that easy to be replicated by competitors. So the sooner you start by creating products, teams, capabilities, education, is going to be very, very difficult for other competitors to reach you in the coming years. So it's a school case. In terms of product, we see that the minimum amount is going down. So that means the regulators are asking for a more distributed approach, and that will go further and further. The idea is that the more you go retail, the most you have to diversify. So a massive use of secondaries, a massive use of private debt. I would avoid co-investment, direct investing, because it's so sexy, but then again, if you create a mess, then I'm sure that the regulator will push you down again. That's my view.
I fully agree. The way we look at it is probably the lower you go into the retail space, the more diversification you need to be providing, in fact, to clients. And that can be done by structuring vehicles that are across the different traditional styles of private equity so that you are not going for only buyout or only venture, but you offer, in fact, the different stages. You offer the different geographies also, which is a way to give this exposure. And You mix secondaries, primaries, so that your profile of maturity of what you're offering to your client is also something that can be shortened in time. And finally, I think that we see a big trend, the same way we've seen it in the public markets towards, in fact, thematics. To speak about something that matters to individuals. It's easier to speak about something like, the green transition and to give examples about that, rather than to speak about buyouts or big caps or mid caps. So we need to put a lot of sense also in what we are telling people.
You covered it, but we have all faced, I think, this trend, whereas, yes, there is a need for diversification when you dig a little bit deeper, but there is also an issue with diversification, or at least with too much diversification, is that the beauty of our asset class is that you need to explain, and to explain, you need not to be too much diversified. And so how do you deal with the two dangers? One is to be too diversified and nobody really understands the fund of fund. To really understand the strategy of fund of fund, sometimes each individual investment is incredibly small. And how you deal with the fact that if you need to explain, you need the examples that you take to have a significant influence in the product of your client. So how are you facing
state-of-the-art reporting? I guess that's one of the key. One of the key is technology again. Technology that helps you through the client experience, the client journey of subscribing, but it's also not stopping there. Yeah. It's very much about the transparency of the exposure, and the better the technology, the better you can dice, in fact, your investments and explain geographies, styles, concentration, sectors, where you will be able to say, well, this manager that we have invested in is contributing X, this is Y, this is how they invest, this is their style. If you're not able to do that, I agree with you, then it's becoming a mess.
We have time maybe for one question. Is there one question from the audience? It's clear to all of you. Yeah, go on, please.
Yeah, just want to put your view about using blockchain when it comes to private funds distribution,
Yep.
primary and secondary.
Who wants to start?
We made some tentative of using structure notes to securitize some private equity funds and sell it to professional clients. But we are in a situation where it's not clear if we are in the good position, and we have some possible regulation problems or tax problems. So there are some few things moving, but we are very...
Marco,
So in 30 seconds, I take that topic and I break it down in two. One is the power of blockchain in terms of making the processes more efficient. Think about what is happening in the entire ecosystem currently in private market. The data, it goes from custodian, administrator, GP, banks, ourselves. It goes from place to place. And every single organization does reconciliation work. It's missing one single source of truth. Blockchain can solve that and can make the entire process more efficient, win for everybody. That's one thing, and actually we are spending quite a lot of time on that one. So that's one side. The other side is how do you access? How do you buy into a fund? Is it worthwhile tokenizing the fund? Obviously, there are a few initiatives that need to be seen, but that goes back to kind of the complexity before and how that from a regulatory perspective is viable. And if that's the way to do it in the future, instead of a fund or in addition to a fund or a structured note, that's the industry will embrace it.
And maybe I can invite you to join us in 1 year, because definitely this is tested by the market. For in our case, we are currently offering the first product of our wealth management product offerings through the blockchain, but it's still relatively new. And probably in 1 year, we will see it has a lot of investment to be able to produce it. But now we will see if the market reacts. So I join you to be with us in 1 year and to cover this topic again. Thank you very much to our panelists.